On today's show, Fidelity slashing fees against a competitor that isn't used to being beaten. We'll have that and more today on Money with Friends. Hey, everybody. Welcome to Money with Friends from my mom's half-finished basement in Detroit, Michigan, where we make the Stacky Benjamin Show. I'm Joe Saul-Sehy.
And I'm Kelly Hultgren, coming to you live from New York. I produce the HerMoney with Jean Chatzky podcast.
This is the show where we take a headline and we not only read it like some podcasts do, but we actually talk about what it means to you and your life. And just like any good friend would with money, we're going to chat about exactly what you can do better. Kelly Hultgren's here with me. Kelly, I'm so glad you're hanging out with us.
I'm so happy to be here. Thank you for having me on.
It's about time that we got you.
I know. So, I'm honored to be considered a friend.
Well, for three people that don't know anything about the HerMoney podcast, tell everybody about what you and this person that nobody knows, what you guys do.
Right. Yeah. So the host of the show is a woman named Jean Chatzky. She's the longtime financial editor of NBC Today's Show, co-founder of HerMoney Media, and author of the new book, Women with Money. It came out earlier this year. And it's a show in which we talk about money. It's for women, as the title suggests, but we welcome everyone to the party. And the show is aimed at increasing women's confidence around money in hopes that it spurs action for them to grow their money in a way that we haven't been socialized to do. And we like to say life is the topic, money is the tool. And that's because there shouldn't be this disassociation with money and life. Like, that's what I feel like we've done, a collective we, for so long. Money touches everything and it's a tool. And so we talk about everything and it makes it more fun for us too. So don't expect dollars and cents, expect more lifestyle-like subjects like finding a roommate or a bunch on healthcare. We talked with Cindy Eckert on her famous pink pill called the Viagra pill for women, and talked about big pharma and how that could trickle down and affect your personal finances. So that's our direction we take, and we have a lot of fun doing it.
I love those discussions, and I love the fact that you never know what to expect on the next episode, which gives it this great texture, which makes it fun to come back for the next show.
Thank you.
Well, today we do know what to expect. We're going to talk about two fun companies battling it out. So you ready, Kelly?
Let's go.
This is Andy from Derby, Vermont. Friends, check. Money, check. Friends with money? Let's do this.
Our first headline comes to us from thinkadvisor.com. And this one I brought to the table. I don't think it's going to be as long a discussion as yours, Kelly, but I also think it's going to be maybe a little clickbaity, because all of us like trimming fees. And in our first headline, this is written by Bernice Knopik at ThinkAdvisor. Fidelity trims fees on target date index funds, undercutting Vanguard. Have you seen this?
I have seen this, thanks to you.
Yeah. All right. Well, let's jump in and see what Bernice writes. Bernice says Fidelity Investments, which introduced several no-fee index mutual funds last summer, has fired another shot in the ongoing price war among passively managed funds, once again targeting Vanguard. It cut expense ratios on the entry-level share classes of its target date funds for individual investors, known as the Fidelity Freedom Index funds, to 12 basis points from 14 as of June 1st. The fees for 21 out of 22 of these funds are now lower than the fees on comparable Vanguard target date funds, according to Fidelity. Most of Vanguard's target date funds investor share class have expense ratios between 13 and 15 basis points. The Vanguard target retirement income investor shares class, however, also charges 12 basis points. Fidelity says the fee cuts will save current Fidelity Freedom Index Fund shareholders approximately $3.2 million annually based on fund assets as of April 30th. Fidelity also cut the expense ratio for the investor share class of some target date funds that serve workplace retirement plans. The fee for Fidelity Institutional Asset Management Index target date commingled pools with assets of $100 million or less is now 12 basis points, down from 14. And the piece goes on, but I think Kelly, our goal here to kick off a discussion about fees and about this change. What do you think that this says? Does it mean that we should all go switch from Vanguard to Fidelity with our funds because now they're cheaper?
I'm not going to say that, but I will say that I think it's a win for consumers in general, because what we hope with a move like this from anyone we're talking about here is that it creates a sea change of lowering prices, right? Like it's a win. So perhaps like this, them putting a stake in the ground on these lower fees will spark a change for more people to do the same.
Yeah, and I'm with you. I don't think in this case, Vanguard's not the enemy. And if you're 0.01 cheaper at Fidelity than you are at Vanguard, that's not going to make a material difference. I mean, they say that it's going to save people, what they say, $3.2 million, but that's across
casually a lot of people.
But yeah, it's across a ton of people. The average person, if you've got $1,000 in a mutual fund, that's not going to save you a material amount of money. I wouldn't make a switch. True. I mean, a material amount of money, sure. But then if we're thinking about how it adds up over time, that could mean something. It could be. I think there's a bigger move here, though. If you're not using a Vanguard or a Fidelity fund, there's a ton of these target date funds, Kelly, that have monster expense ratios and really for no reason. Well, should we talk about who target date funds are for? Let's do that. Let's talk first. Okay. Let's go even broader than that. Let's talk about what a target date fund is. You want to do that? Sure. I'll do my best to do that. So target date funds are a fund that essentially align with a year in which you're thinking about retiring and adjust your asset allocation closer to retirement. Is that a good start? Yes, absolutely. Yeah. And as you get closer to retirement, it gets more conservative. So you don't have to diversify the fund. It's already diversified for you. It's based generally on your goal because you're basing it on a year. And and you're going to reach it. Do you like target date funds? I'm in one. So yes, I do. And what we've talked about a lot on HerMoney, and I'm going to put myself in this too, they're really good for the more hands-off investors. Yeah. So people who are, more favorable of the set it and forget it methods of our money when it comes to saving and investing, target date funds tend to be a really good choice for people like me. Now, OG and I like them kind of, but we generally don't like them because 75, and only for one reason. And it's that about 75% of these funds have really, really high fees. So if you're in a good one, if you make sure the fees are down there where Fidelity, Vanguard are at, it's fantastic. But we've seen so much garbage in this industry, Kelly, just because people are hands off. They don't pay attention to the fees. So a great place to go is a place like Morningstar.com and just check out your fees and make sure that you're not paying an arm and a leg for something that you can get much, much less expensive at a family like, and I'll give you a few. I mean, Fidelity, T. Rowe Price, Vanguard. I think you'll be good with any of those three families as a nice start. So who is the most competitive then in terms of fees here? Like what's a low fee and then what's a fee that you don't even want to look at the account with? Yeah, good point. You're looking here at Fidelity. It says 0.12%. So 0.12% is a phenomenal fee. If you're generally, I think, less than 0.5%, you're okay. But you'll see these funds that have a 1% fee, but it's also a collection of garbage funds. So let me tell you what happens. Tony Bourdain. I absolutely love Tony Bourdain's writing. I'm so sad that he's passed away because I thought he was just such a bright light on getting people like me to understand cuisine. Tony talked about things not to eat in his first book, Kitchen Confidential, and he talked about the Sunday brunch. And the Sunday brunch is everything that the chef couldn't sell all week. So they combine them up into a salad so you don't see how bad this stuff is. And then you get this Sunday brunch with a bunch of salads. So Sunday brunch, generally not that great. I will tell you that for many fun families, a target date fund is the Sunday brunch of mutual funds. And the reason is they have these funds they can't sell very well. So they take them and they put them together. Bad fund is the international fund. Bad fund is the large company fund. They charge you 1% for management. And all these funds on top of that have a manager that's managing them on the inside. So you might have 2.5% of mutual fund fees in these funds. So I'd say if your fund's over 0.5%, I would stay away. I think the industry average, we did a story with Morningstar about this just recently, like 0.8.
Yep.
I think it's 0.8 is the industry average.
I saw 0.75 to 1% is the industry average for annual fee. And it's something I need to pay more attention to too. It's now I'm questioning mine. I think mine's around 0.7 actually.
Yeah.
So I need to revisit that then.
Well, you've got a couple here, Fidelity and Vanguard, duking it out, right?
Yeah.
And,
That's true. That's true.
Definitely not the problem. But when we have people write into us, they're like, I hear you don't like target date funds. I'm in a Vanguard one. I'm like, no, you're not the problem. You're fine.
It's interesting, but they also take out, so for women in particular, we know that investing can be pretty emotional, and target date funds also, in a way that it is for the more hands-off investor, it does remove some of the emotions out of investing as well, especially if you are not as willing to take on as much risk as maybe you should, especially earlier in life. Yeah. That was me too. With loss aversion in mind, like it's really helpful to have someone just do it, like have the allocation, closer to 90%, which is where I'm at right now, and have it be done for me without me actually manually doing it myself. Like it helps. So I think that's another positive thing about target date funds.
I think that you also know that it's handled well. I mean, these people are fantastic pros that are running it.
Absolutely.
So you don't have to worry about Earl and Peoria making the wrong move. It's all
Peoria, Arizona.
Right. Exactly. Yes.
I'm from Arizona, so I knew that.
I was thinking Peoria, Illinois, but yes.
Oh, okay.
Yeah.
Probably similar.
The other Peoria. The other one.
The other Peoria. Okay.
One last thing before we put this one to sleep, because we've got a much better, this is a great conversation, but the second conversation we're going to have today is phenomenal. Where does this end, do you think? I mean, Vanguard slashes fees, Fidelity now going after their lunch, right? We're seeing, it feels like, I think the word they used here is an arms race. It feels like this race. Where does it end, Kelly? Where do you think we end up?
Do we end up with 0%, like no fee, a no fee product?
Somebody was even saying because they make so much money in other ways that it may end with us being paid. Do you think we'll ever see that? I'll give you $10 if you invest in my thing.
If you start one of those, let's start one of those. Let's do it.
Let's do that.
Yeah.
We do this live in front of a Facebook audience, so we're glad that we've got some friends here with us. Going to say hello to Gregory. Sandy is here from Yes, I Am Cheap, and you saw her last week on the show. We also have Kimberly here with us. Craig's here with us. Glad you guys are here, and if you've got comments, feel free to join the discussion in the comments. If you want to hang out with us while we make this live, it's facebook.com/iStackBenjamins, the Stacking Benjamins Facebook page. Kelly, what's your big takeaway from this one?
I think my big takeaway is that I didn't realize how competitive these fees were on the market. So I think it's a good sign for all of us to go back if we have target date funds like myself and start kind of price comparing for ourselves moving forward and making sure that, if we could be saving more on fees and therefore putting more money to work for us, we should absolutely do that. But also it was a good reminder for me, to have a check-in every single year to make sure you are investing in the ways in which you would like to be or that are best for you in your future in your target date fund. Any information like this that kind of serves as a reminder, how, what am I doing? Where is it at? If you haven't checked in the past year, do.
Yeah.
That's my big takeaway. What about you?
Yeah, my takeaway is very similar. It's that target date funds can be your friend, but they're very much a commodity. So the one differentiator for the most part is fees. They all use modern portfolio theory. They're managed very similarly. So check your fee to make sure it's competitive before you choose a target date fund.
Yeah, that sounds good.